Welcome to FinTech Bot Focused, where we discuss, dissect, and implement all things automated trading. If you're into AI tools, trading bots, and FinTech innovations, make sure you subscribe. Let's be brutally honest, 9 out of 10 trading bots lose money, not underperform, not miss targets, lose actual money. And before you think it's because trading itself is impossible, hold that thought, because the real reason is way more fixable than you'd expect. I'm going to walk you through exactly why this happens, show you a real side-by-side comparison of what looks great on a spreadsheet versus what actually happens when real money is on the line. And then, here's the important part, I'll show you how the smart minority avoids this trap entirely. So, let's start with the biggest killer, overfitted backtests. This is where most bot builders live. You take historical data, you tweak your strategy parameters until the numbers look absolutely beautiful. Maybe you get a 40% annual return in your backtest. It feels real. It feels possible. But here's what's actually happening. You're not discovering a winning strategy. You're curve-fitting noise. You're optimizing so hard to pass data that your bot has basically memorized it instead of learning from it. The moment you deploy that bot into live trading, market conditions change slightly, volatility shifts, and suddenly your edge vanishes. The parameters that were perfect for 2023 data are now a disaster in real market conditions. This is why you see backtests showing massive returns and live trading showing massive losses. Now here's where it gets really interesting. Let's talk about the second killer, fees and slippage. Most backtests don't account for these realistically. In your backtest, you might model a 0.1% trading fee, but in reality, if you're trading frequently on most exchanges, you're paying way more than when you include maker-taker fees, potential price slippage on larger orders, and withdrawal costs if you're moving money around. On a $10,000 account with high-frequency trading, that can easily eat 2 to 3% of your capital per month before your strategy even has a chance to work. And this brings us to number 3, zero risk controls. The bots that blow up accounts don't usually lose money on bad trades. They lose everything on one catastrophic trade. No position sizing, no stop losses, no account drawdown limits. A bot can backtest beautifully, deploy live, hit one surprise market spike, and suddenly you're looking at a 50% drawdown or worse, with no emergency break. Here's what separates the bots that actually make money from the 90% that don't. First, they use out-of-sample testing. They don't optimize on all their data. They optimize on a chunk, then validate on data the bot has never seen. Second, they account for realistic slippage and fees from day one. And third, this is critical, they implement hard risk limits, position size caps, maximum drawdown stops, circuit breakers that pause the bot if something smells wrong. The minority that wins isn't smarter, they're just more disciplined about what they're measuring and more honest about market realities. Before you go, make sure you join the FinTech Bot Focus newsletter. You'll get updates on new bots and AI features, strategy breakdowns, my honest takes on what's working, early looks at new automated trading tools, and you can reply with video topics you want covered. The link is in the description. Join the community and stay ahead of the automation curve. Disclaimer. This video is for educational purposes only, not financial advice. Trading, especially automated trading, involves risk. Always trade at your own risk and test everything before going live.